wonder why banks are so eager to keep your money safe? Why do they encourage you to deposit, offer you interest, and even throw in a few perks? It sure isn't just about keeping your money locked away for you. Yes, banks have a much bigger plan in play, and your deposits are right at the center of it. Let's break down exactly how banks make serious money from the cash you trust them with. Deposits are not just sitting there. When you deposit money in a bank, it doesn't stay in a vault gathering dust. Banks are legally allowed to use most of that money to fund other financial activities. It's called fractional reserve banking, meaning they only need to keep a small percentage in reserve. But what happens to the rest? They loan it out to businesses, homeowners, and even to other banks. Every loan they issue earns them interest, which becomes one of their biggest sources of profit. So while your money feels safely tucked away, it's actually busy making the bank richer. Loans, the heart of profit. Think about mortgages, car loans, business loans, or credit cards. All of these come with interest rates attached. Banks lend out your deposited money at much higher rates than they pay you for keeping it. For example, you might earn 1% interest on your savings account, but the bank charges 6% or more on a mortgage. The difference between what they pay you and what they earn, called the interest rate spread, is pure profit for them. The more deposits a bank collects, the more loans it can issue, and the more it earns. Investing your deposits. Oh, and banks don't just lend your money. They also invest a portion of deposits in government bonds, securities, and other relatively safe investments. These investments bring in steady returns with low risk. Government bonds are a favorite because they are almost guaranteed to be paid back. So, by investing wisely, banks create another steady stream of income, fueled by the deposits sitting in your account. It's like your money is quietly working a second job, but for the bank. Fees, another quiet stream. Besides lending and investing, banks also make money by charging you fees. We are talking about account maintenance fees, ATM charges, overdraft penalties. Even if your deposit stays untouched, the bank finds ways to squeeze value out of it. These fees are small individually, but when multiplied across millions of customers, represent billions in revenue every year. Building trust to grow bigger. Your deposits do something else too, they build trust. The bigger a bank's total deposits, the stronger and more credible it appears to investors, regulators, and customers. Also, large deposits mean stability, which allows the bank to expand. They can open new branches, merge with other banks, and even take bigger risks. In this way, your small deposit becomes part of a much larger business strategy. Your trust helps banks grow their empire. The balancing act. But banks have to strike a balance between keeping enough cash on hand and putting as much of it to work as possible. Regulations like the Basel III Accords ensure banks don't get too greedy with lending. Still, the goal remains the same: to minimize idle cash and maximize returns. If too many customers suddenly demand their money back, known as a bank run, the system could collapse. That's why reserve requirements and insurance schemes like FDIC in the US exist. They make sure banks stay safe while still profiting heavily from your deposits.